Right now, one of the greatest quality compounders in the stock market is on sale. Chipotle Mexican Grill, ticker CMG, is currently trading about 34% off its recent highs. For a company that has historically been the fast casual king, a drop of this magnitude isn't just a dip, it is a full-blown correction. But here's the million-dollar question. Is the growth story permanently broken, or are we looking at a quality asset disguised as junk? If you follow me, you know we typically look for two specific triggers: a valuation dislocation and a technical discount. Right now, for the first time in years, Chipotle is seeing green lights on both of these. In today's video, we're going to go deep into the economic reality of Chipotle. We're going to look at why the market is currently pricing this stock as if its best days are behind it, and I'm going to show you why I believe this might be one of the most obvious buys on our watch list today. We have earnings coming out tomorrow, February 3rd, so the timing of this analysis is critical. Let's get into the numbers. Let's start with the hard data. The current price of CMG is sitting around $38. To the average retail investor, that number doesn't mean very much without context. But to us, context is everything. Our first diagnostic check is valuation benchmarking. Historically, Chipotle is not a cheap stock. Over the last 5 years, its average PE ratio has lived in the 55 to 65 range. During periods of peak euphoria, we've seen this stock traded over 90 times earnings. I can admit that is very expensive for a stock, and I would normally question a valuation that high. Today, however, Chipotle's adjusted trailing 12-month PE has compressed to roughly 34 times. Think about that. You're looking at a 40% discount compared to its historical average valuation. In fact, 34 times earnings has historically acted like the floor for this stock. We're currently at the absolute lower end of its 5-year range. When we look into 2026, the forward PE is sitting at around 32 times. The market is essentially pricing Chipotle as if it's a slow-growth utility company rather than a high-performing compounder. This creates what we call a massive margin of safety. You aren't just buying a great business, you're buying it at a price that assumes the worst is already here. Now, valuation tells us what to buy, but technicals can also give us some insight as to when to buy. I tend to want to buy quality assets when they're technically suppressed. Let's look at the 200-day moving average for Chipotle. It currently sits at approximately 43. With the price between 38 and 39, we're trading nearly 10% below the 200-day trend line. Contrast this with the rest of the quality names in the market. Google is still trading well above its trend. Microsoft was trying to break out of theirs until their recent earnings. Chipotle, however, is already deep in the contrarian value zone. This is a technical discount that aligns perfectly with our valuation thesis. When a stock is below its 200-day moving average and trading at a multi-year low PE, that's when I'm going to start paying attention. Now let's talk strategy. Chipotle is a textbook quality stock. Right now, momentum traders are treating it like it's junk because the price action is ugly. But if we look at the economic reality of the business, they aren't relying on credit markets to survive. They use their own cash flow to build new stores. Their return on equity remains a staggering 45%. Many famous investors follow this simple business rule. They avoid complexity. Chipotle is as simple as it gets. They sell rice, beans, and protein at a premium. The toll booth here is the habit. For millions of Americans, Chipotle is the default healthy fast food option. When you have a business with 40% plus returns on equity and a brand that has become a daily habit, and you can buy it for 34 times earnings, that's the literal definition of quality at a reasonable price. The market thinks the habit is broken. I believe this is just a temporary cyclical pullback, partially driven by inflation fatigue rather than a structural failure of the brand. Now, on the other side, to be a good investor, you have to look at the antithesis. Why is the stock down 34%? The bears have three main arguments right now. The first is the low-end consumer cliff. About 40% of Chipotle's sales come from customers earning less than $100,000 a year. This group is feeling the squeeze of inflation, leading to what analysts call pricing fatigue. If that 40% starts cutting back, growth will slow down. Second is margin compression. Chipotle's magic is throughput, the speed at which they move people through the line. If traffic slows, they lose that leverage, and the margins take a hit. Finally, there's the noise. You've seen the headlines about portion sizes and complaints on social media. Sentiment is currently broken. But here's the signal. While the headlines are focusing on portion sizes, the business is still opening new stores with over 80% cash-on-cash returns. The engine is running perfectly. The drivers are just nervous. So how do we play this? Chipotle is currently in what I call the green light zone. As long as the price stays between $35 and $40, I'm going to rate it as a buy for my portfolio. The logic is simple. As long as it remains below the 200-day moving average of 43 and the PE stays under 40 times, I consider this an accumulation point for a premier compounder at a massive discount. Now, fair warning, earnings are tomorrow, February 3rd. Expect volatility. If the company guides down on same-store sales, the stock could flush lower, potentially toward 35. If that happens and the fundamental thesis isn't broken, that just further solidifies the buy thesis. What do you think? Is Chipotle still a quality play, or is it really junk? Let me know down below in the comments. As always, I do thank you for watching. I very much appreciate your time. And if you would, please care to leave a like. It would really help the channel. If you want more content like this, please consider subscribing, as I do a few of these each week. Thanks again, and I'll catch you in the next one.